Hello, and welcome to the Birkenroad Report's video presentation of continuing coverage for Gulf Island Fabrication. My name is Ethan Samuels, and I will be presenting on behalf of our analyst team. That team is made up of Kelly Oquin, Emma Bronze, Edward Brucoleri, Catherine Gillespie, myself, and our investment research manager, Brad Bogus. Our team has forecasted a market perform rating and a target price for Gulf Island of $18 per share, increasing 15% from the current share price of $15.69. We arrived at this valuation by focusing on four key areas: the history and strategy of Gulf Island, and some recent news in the industry relating to our investment thesis. After we talk about that, we will discuss in detail our valuation methods and some key risks of Gulf Island. Gulf Island Fabrication provides products and services for offshore drilling companies specializing in construction services and offshore platform fabrication. Alden Laborde and Huey Wilson founded Gulf Island Fabrication in 1985 in Houma, Louisiana. After going public in 1997, the company further diversified its offerings through 5 subsidiaries located in Texas and Louisiana. Most recently, the company relocated its headquarters to Houston, Texas in 2013. Gulf Island and its subsidiaries specialize in building offshore drilling and production structures, including platforms, deck sections of fixed and floating platforms, piles, utility modules, and construction and repair of marine vessels. Gulf Island's strategy centers on offering its customers superior value through quality facilities and equipment, knowledgeable personnel, and efficient services. The company's 650-acre fabrication space among its 5 subsidiaries allows the company to provide its customers with some of the largest offshore structures in the Gulf. Barriers to entry are relatively low for domestic competition to enter the market for smaller offshore structures. However, Gulf Island has sufficient expertise, an ideal location, and appropriate facilities to produce larger equipment for water depths beyond 300 feet, a distinct competitive advantage. In addition, Gulf Island offers a trustworthy reputation and safety record that facilitates strong customer relations. From a financial perspective, Gulf Island's goal is to maintain a strong balance sheet that mitigates risk and provides financial flexibility. At the end of the third quarter of 2014, Gulf Island had $26.7 million in cash and no long-term debt. Gulf Island faces competition from platform fabrication companies that competitively bid on project contracts. Most of the company's competition comes from domestic competitors, including Kiewit Offshore Services, State Services Company, and McDermott International. For fabrication projects in waters deeper than 300 feet in the Gulf of Mexico and in international waters, Gulf Island's major domestic competitor is Kiewit. Moving forward, we will now discuss some more recent developments and their impact on the future of Gulf Island. The oil price plunge in the last quarter brings into question the fiscal feasibility of the expensive deepwater drilling industry, a main component of Gulf Island operations. Oil prices in the $65 to $75 per barrel range would likely stimulate more deepwater drilling activity, but prices as of February 2015 were below $50 per barrel. Because of the high initial investments, deepwater wells are currently less financially feasible with lower oil prices. Therefore, Gulf Island's deepwater competitive advantage will be reduced while oil prices are low. Any further decline in oil prices would impose more downward pressure on rig activity in the Gulf of Mexico, which would negatively impact Gulf Island's revenues. However, a steady oil price recovery would re-energize rig activity in the Gulf and bolster revenues by providing the opportunity for Gulf Island to win more contracts. The current low levels of activity are one factor leading to the company's diminishing backlog problem. Backlog is an important indicator of revenue in the near future because it represents the amount of direct labor hours needed to complete active contracts, and the amount of revenue yet to be recognized in those active contracts. Backlog revenue peaked at $614.5 million in 2011, declined to $358.7 million at the end of 2013, and as of the end of 2014, revenue backlog totaled $184.7 million. The substantial backlog in 2011 was almost entirely attributable to two large deepwater projects. However, there has still been a noteworthy downward trend in backlog in the past 4 years. Diminishing backlog paired with an increase in terminated installed projects could hurt future revenues. Though oil-based projects in the Gulf may be slowing down, a northern wind is blowing new and unusual projects Gulf Island's way. Gulf Island secured a contract with Deepwater Wind in November 2014 to construct jackets and piles for the company's offshore Block Island wind farm off the coast of Rhode Island. This project will be the first offshore wind farm installed in the United States. Gulf Island's involvement in this project, and possibly 2 more in the works, puts the company at the cutting edge of the offshore wind industry. All of these new events and projects have led us to our market perform valuation of Gulf Island. Our valuation of Gulf Island is based on a weighted average of multiple valuation methods, including a discounted cash flows model and 3 different types of the relative multiple model. Our forecasting was done using multiple regressions and percent change in common size amounts of income statement, balance sheet, and statement of cash flows information. The most notable forecasted number in our report is the trend of revenues. Using a combination of a regression and growth rate model, we have forecast a slow decline in revenues until the year 2017, at which point revenues will begin to increase through the year 2024. The variables we included in our regression were Texas GDP, fourth quarter seasonality, Gulf of Mexico rig count, oil prices, and a recession-based dummy variable. Though our valuation is carefully computed using reliable information sources, it is subject to the same risks as the company itself. The risks Gulf Island faces include fluctuating commodity prices of both steel and oil, the impacts of seasonality and weather, and its small customer base. Because Gulf Island employs a fixed cost method of bidding, in most cases, fluctuations among variables, such as steel, can cause margins to increase or decrease. To mitigate steel risk, Gulf Island receives forward-looking reports from the industry and prepares accordingly. The price of oil can be extremely volatile and is the largest commodity risk to the company. An increase in supply shocked the market in late 2014, and the price of oil has since plummeted. According to IBISWorld, the price of oil is expected to increase in the next few years to around $60 to $70 per barrel, as shown in this graph. Cost-intensive projects like deepwater drilling will become too expensive to continue, and these are the projects which Gulf Island relies heavily on for its revenue. Gulf Island is subject to the same weather risks that any company operating out of the Gulf of Mexico could expect, including harsh winters and hurricanes, with most work being completed in the milder summer months. Gulf Island earns the majority of its yearly revenue from a small number of major energy companies. While the companies are not always the same year to year, the amount of work performed for a few customers remains significant over time. Together, Williams Field Services and Chevron USA comprised 60% of revenues in 2013 and 61% of revenues in 2012. If Gulf Island's customers decide to reduce or cancel projects or to decrease capital expenditures, the impact on Gulf Island's operations could be significant. Similarly, since the majority of Gulf Island's revenues are derived from a small number of large projects, failure to secure 1 or 2 of these large contracts could significantly reduce Gulf Island's revenues. In conclusion, our target price of $18 is based on Gulf Island's history, current performance, and future prospects. Gulf Island will continue to operate in the profitable way it has for many years. However, changing trends in the industry will force them to reconsider their positioning for the future. Thank you for listening to our presentation. If you would like more information, our full analyst report is available at www.birkenroad.org.